Hey, this is Sasha. Welcome to another episode of Hungry for Returns, where I answer your trading and investing questions based on my own personal experience and knowledge. If you have a question, be sure to submit it at tradersfly.com. Let's take a listen at today's question, which talks about buying the dip.
Hey Sasha, I'm a subscriber for you, and my question is, I'm a long-term investor, and you know, when the big companies such as Facebook, Microsoft, and all that kind of big companies, when they dip for very low prices, I want to buy them again. But the problem is, when should I buy it? How long I need to buy that stock? Because buy it in the deepest, lowest price is very dangerous. So I want to buy this stock when it's go up or go down. But the problem is, how long should I wait in it? 1 week, 2 weeks, 3 weeks, 4 weeks, 1 month, 2 month? And thank you very much.
Okay, so if we take a look at this question, really we're looking at buying the dip. When should you buy the dip on the stock? So companies like Facebook over here, they'll have these big dips. So if you take a look over here, what we just did about August 30th, we had a massive dip. Percentage-wise, you're looking at about 20%. And if you're looking to buy these companies into the future, this is typically what you're trying to do when you buy the dip. There's a couple of things you need to consider, and I want to share with you 4 main points that I jotted down when you're looking to buy the dip. Okay, so the first one just answers the question directly of how long should you wait until you buy the dip. Now, let's take a look at history. Typically, a consolidation phase is 6 to 8 weeks. That's a typical sideways movement, digestion phase. So if you look at many stocks that are just moving sideways, pick any company, for example, that'll move sideways on the trend, 6 to 8 weeks. This is average looking at history. Sometimes this could be a little quicker. Sometimes this could be a little bit shorter. So look at any pullbacks, distributions, those kinds of things. 6 to 8 weeks is a typical guideline. Okay, sometimes it could be 3-4 months, 5-6 months. Sometimes it could be a couple of weeks. But overall, when you have some massive movements in stocks and companies like Facebook over here, that can take a little bit longer. The same thing can happen when we look at a Netflix. These major pullbacks can take a little bit longer, so you need to be more patient. The more violent things are, typically the longer it takes to digest things. Just like the more food you eat, the longer it takes to digest that food. Okay, so I want to share with you a couple of other 3 main points beyond this, just the time frame, and that is watching the retracement. So for example, when you look at stocks like a Netflix here, you have to be very careful with these retracements. And by the retracements, I'm talking about the bounces that come shortly after that pullback. And typically those bounces are about 50%. Now here in Netflix right now, you can see it's about a 30, 34, 38% bounce. So look at Fibonacci sequence and learn more about those if you're interested on fib levels. But that's a typical kind of sequences right there. It bounced to about a 350 level and then it pulled back even further. If we take a look back at our Facebook example, which was directly in the question, the same thing happens, is that we have a major sell-off, right? We have a bounce of about 12%. So take a look. We had a sell-off of about 23%, and we had a bounce of about 13%, and then we got further selling pressure. So I want you to be very careful here on point number 2, is that you might get a follow-through sell-off action or sell-off moment just a couple of days or a couple of weeks later. And that's what you want to be cautious about, because you don't want to be the guy buying right here, getting in, and then it comes back, and sometimes it even goes lower. Now, this brings me to another point right here, and that is distributing your cash amongst multiple time frames. So if you distribute your cash, let's just say a little bit here, and then also a little bit at even further lower prices, that will help you avoid piling in too much risk all at one time. Because yes, you'll never find and catch the bottom. It's very rare to do so. Although of course some people do every single day because there is a bottom. So there are some people that do end up catching the bottom every single day. But most of the time it's very difficult to catch a bottom of a swing movement, multiple weeks or multiple months. So that's tough to do. So in either case, what you're trying to do is kind of distribute your cash, and that'll help eliminate your risk. So again, if we take a look at, let's just say, an Amazon example. So as we look at moving to the upside right here, let's just say you bought kind of on the dip around March, which was not at its lowest point when it dipped in April, right there, and you missed out a little bit, but then you're building your position, and maybe you added again around May, but about at the same price level. Then you add it again in July, and that'll allow you to be a little bit more safe. Remember, when you look at major market movements as far as how long a massive crash and correction takes, anything between about 2008 and 2009, and then also 2000 to about 2002. So these pullbacks took about 1.5 years for the 2008, and the 2009 the 2000 crash took about 2.6 years. So if you're distributing amongst, let's just say, 3 to 6 months, that'll kind of keep you fairly safe. If you want to go take, let's say, $12,000 and split it amongst, you know, 1,000 every single month, well, that'll kind of get you at least partly away from the last couple of crashes as far as time goes. The other point I want to make here, and we can just use this S&P as an example, is that when you do have market pullbacks, one other thing you could do as far as technical analysis goes is look at a descending trend line. Okay, so you take a look at this descending trend line, and you could be a little more patient and get in it after it breaks that descending trend line. You can do this on shorter term scales as well. So let's say you're looking at 2011, 2012, you have 2011 where we have a pullback, you could get in it just above that breakout of that descending trend line. And of course, if you're looking at individual stocks, looking at it like an Amazon here, here's kind of our descending trend lines that you could use and just try to get in, you know, after it breaks those points. Looking at that Facebook example that we've used earlier, so let's just take a look here. So here you can see the earlier 2008 February March pullback. The entry point kind of was a little bit around the April May time frame. And now the same thing, what you'll want to do is looking at the most recent movement. So here, as we draw that line, it's a little steep. It's too far to create it right now because it's angled so steep. So you'll want to get a line maybe around kind of a upward slanting normal healthy pullback. So somewhere around this level could be, right now looking at it, about 182, 185, 180 could be a nice level if it breaks out above that point. So anyways, that's kind of what I would recommend, is look at those kind of 4 points. How long should you wait? 6 to 8 weeks is a typical average distribution, but looking at a long-term correction, 1.5 years, distribute your money is the other point. So that's another point that you want to pay attention to. Looking at the retracements, a potential bounce, and watch the descending trend line there on these pullbacks. So of course, you'll never find the bottom of just about any stock. It's very difficult to do that very consistently, but hopefully looking at it in this way with a couple of these points, it may help you reduce your risk. Anyways, thank you so much for joining me. I hope this answers your question. By all means, feel free to sign up to the newsletter list if you want to get more news and notified when I release more questions and answers like this one, or subscribe on YouTube. Thanks again, and I'll see you next time.